An important concept in finance is something known as the cost of capital. The cost of capital represents the minimum rate of return a company must earn on any investment to justify the use of its financial resources. I know of one firm that likes to simplify the thinking with the phrase, the expected return is the cost of capital. Simply put, it's the expected return that convinces investors or lenders to fund a project or business operation. People who are less creditworthy have higher mortgage rates than those who are reliably showing a strong cash flow. The concept is crucial because it helps determine whether any investment will generate enough return to cover its financing costs. For nearly 2 decades after the global financial crisis, which ended in March of 2009, companies benefited from historically cheap capital. Borrowing costs were often at or below the inflation rate. That low-rate environment has recently shifted as the Federal Reserve and other central banks have raised interest rates to combat inflation, pushing long-term yields to their highest levels in nearly 20 years. Money isn't as cheap as it once was because lenders are perceiving greater risk. Those higher rates are being driven not only by geopolitics and energy market concerns, but also by structural forces such as rising federal debts, AI infrastructure spending, and energy system investment. Growing government deficits and debt are expected to crowd out private investment and keep long-term interest rates above pre-pandemic levels. Meanwhile, massive AI-related capital spending by hyperscalers is increasing demand for external financing and creating greater competition for capital. Artificial intelligence investment extends beyond technology infrastructure to energy grids, generation capacity, cooling systems, data center real estate, and other capital-intensive assets. The post-global financial crisis era of abundant, inexpensive capital now seems to be ending, with many large companies likely to face higher weighted average costs of capital down the road. Cheap capital encouraged corporate managers to tolerate low-return investments and focus on growth metrics. Until now, companies could create sustainable value when growth generates returns above the cost of capital. Going forward, growth that fails to clear that hurdle can destroy value. In a higher cost of capital environment, companies that allocate capital rigorously, invest selectively, and connect strategically to economics will be better positioned to outperform. The federal government is working hard to create incentives for accretive capital spending that prioritizes economic growth. There's a strong consensus that Canada has lagged in terms of competitiveness over the past decade or more. As the world becomes more fragmented and unpredictable, both in terms of political alliances and trading partners, and in finding suitable places to deploy capital, it's important to follow the money and to watch how people allocate capital in light of a growing cost of capital.